So the first option strategy we're going to be talking about today is purchasing call options. These are a high-risk strategy, but they're an excellent way to make large gains very quickly if you're confident in your moves. Before we get started discussing this strategy, we're going to have a small disclaimer before we go any further. You have to understand that call options are extremely risky. You can either multiply your initial investment by 10 or lose your investment entirely. So don't play options unless you're 100% confident. Let's say there's a stock out there that you think is going to release some good news, and the stock price is going to rocket up higher. Right now in October, the stock is trading for about $21. But you think that the company is about to make a big announcement and the stock is going to go way up, probably above $25. Now conventional wisdom might tell you, why don't you go ahead and buy some shares? You can get them right now for $21. You think it's going to go up above $25, go ahead and sell it at $25. When it reaches that price, you would have made $4 on every 21 that you put in, which is about 19%. Most people would spend an entire year hoping to even get close to 19% profit. Why not just buy the shares? But if you're that confident, you can make 19% look like chump change by using a call option. When you purchase a call, you are buying a contract that allows you to purchase shares at a certain price called the strike price, at or before a certain date in the future, which is called the expiration date. And for that opportunity, you must pay what is called a premium to the person who is selling the contract. The contract is always for 100 shares. So let's go back to our example of the stock. The stock is trading for around $21, and we think it's going to go up to at least $25 and most likely beyond that. So what we're going to do is buy a call option at a strike price of $25 that expires in November. And remember, what this is allowing us to do is purchase 100 shares per contract at the price of $25 at any time at or before the expiration date in November. So, November 23rd, in order to have this privilege to buy 100 shares at $25 at any point at or before November 23rd, we must pay a premium to the person who is selling the contract. Remember, when he sells that contract, he's obligating himself to sell shares to us at $25 at or before that date. And if you're going to take on an obligation like that, you're expecting someone to pay you for it. And that's why we as the purchasers of calls must pay the premium. Let's say in this case that the premium for this contract is about $100. And for a stock that goes up and down as fast as the example we have here, I think that's pretty realistic. So let's expand a little bit on why we might choose calls instead of buying shares in this situation. In our example, one share of stock costs us $21. So if we apply just a little bit of math, we'll see that 100 shares of stock would cost us $2,100. As we can buy 100 shares for $21, or we can buy one contract which controls 100 shares, and we wouldn't have to spend $2,100 on it. We would only have to spend $100 on the contract. But now you've got an extra $2,000 lying around. So let's go a lot deeper into this stock. You want to spend $2,100 on this bet. So let's go ahead now and not buy one contract for $100, but let's go ahead and buy 21 contracts for the same price as 100 shares. $2,100 for 21 contracts. And by holding those 21 contracts, we are now to control 2,100 shares of stock. We spent that same $2,100, but now we own a lot more shares, so we can amplify our gains when the stock price increases. So for simplicity, let's continue our example. Assume that you only bought one contract for $100. Well, we like that deal. We think that sounds pretty good, so we're going to go ahead and buy our contract. We're going to pay the $100 premium, and we're going to wait for the stock price to rise. Now, sometimes this wait can be the most difficult part of owning a contract, because you know that while you're waiting for the stock price to rise, that contract is becoming less and less valuable. When we purchased that contract, we had an entire month until the contract expired. Now, as the days tick by, we have fewer and fewer days until the contract expires. And if the stock does not move to where we think it may end up finding out that our contract is useless. If the stock doesn't go up above $25, what good is having that contract if it's below $25? So we're not going to take the opportunity to buy that at that price. Instead, we're going to end up having to throw that contract out, and the entire $100 premium is wasted. Now, I hope watching this clock tick for the past minute has been painful, because when you're watching a stock, waiting for it to rise while your contract becomes more and more useless, it can hurt really bad. So I hope this experience has hurt you enough that you can understand how painful owning calls actually is. And that's enough of that. So we've waited around very patiently, November has rolled around, and we're absolutely right, the stock has increased substantially. We even have a whole new line up to $30 just showing where the stock has gone. We thought it would go above $25 and we were absolutely right. The stock has gone all the way up to $31. And our contract is good to purchase it way down at $25. We can purchase it for $6 less than what it's currently trading at because we bought this call. And remember, we only had to pay a premium of $100 for this call option, back when the stock was still trading around $25. So let's think about this. We paid $100 for this contract, and this contract represents 100 shares. So essentially what we've done is paid a $1 per share premium to purchase this option. Now here we are 1 month later, and the stock is trading for $6 higher than the strike price previously. This call option only commanded a $1 per share premium, but now the stock is trading for $6 higher than the strike price. This option now commands a premium of $6 per share. In other words, this contract you paid $100 for is now worth $600. Now, when you think about it, it makes sense. The stock is trading for $6 higher. You have an opportunity to purchase 100 shares with this contract. So if you can purchase at 25 and immediately turn around and sell it for 31, it makes sense that this contract is worth $600. You bought this contract for $100 and now it's worth $600. That means that you multiplied your investment times 6. Getting returns like this would take forever, but we can see how using options can make that happen very quickly, sometimes within a matter of hours. Now, I caution you that sometimes people will see a large return and they say, well, if I did that with one contract and spent only $100, why don't I go ahead and buy 100 contracts for $10,000 and make an even bigger chunk of change? And yeah, sure, in this case it would have worked, and you would have gone from $10,000 all the way up to $60,000. And here is an example of a guy who doubled his money. He made $23,000 in one day. This guy here quadrupled his money. And then we look at another example right here, where this guy bought for $11,200 and sold for $19 grand, made $8,000 in a day. So it can be done, yes, absolutely. But remember, it doesn't always work out that way. Remember, when we bought that contract for $100 in premium when the stock was trading at 21, let's look here, how much it went down. Do you think that contract is still going to be worth $100 when the stock goes down a couple days later? It's not. That contract is going to be worth less because the stock has to increase by a larger amount before the contract is worth anything. So let's say it's only worth now about $20. You spend $100 and now it's worth $20. You suffered an 80% loss in just a couple of days because that stock went down. And if you thought that you were smart and you wanted to buy 100 contracts at $10,000 when the stock went down, you would have lost $8,000. Can you stomach an 80% loss? Sometimes things like this happen. Here, we'll take a look at a guy who lost $23,000. So in conclusion, we want to make sure that we're taking calculated risk when purchasing our call options. They could end up making us a lot of money or losing us a lot of money. And always, stay bullish.